What's up, guys? It's Brandon from Amphibian Trading. As always, make sure you hit that like and subscribe button so you don't miss any future updates. And with that out of the way, let's get right into this week's video. So this week, I'm going to focus on the Nasdaq Composite, which had a strong week, finishing up a little over 3% as we had some positive data on CPI and PPI, both coming in lower than expected, showing that inflation is starting to cool down and the Fed raising interest rates is starting to work its way through the economy. Now, we came into this week in this zone here with the blue rectangle. Monday and Tuesday, these two bars here, we actually stayed in that zone. And then Wednesday, we got that CPI report, and that's what really got the move started this week. Now, if we look at the market navigator, we still have a power trend on, our buy switch is on, and our exposure count is at a 7, which is the highest level it can go to. We started the week with 5 distribution days, and the strength we saw on Wednesday and Thursday was actually enough to knock 2 distribution days off of the count. So these 2 distribution days here are now no longer counted towards the distribution day count. And there's 2 ways that a distribution day can come off of the count. The first being if 25 days has passed since that distribution day, and the second being if price moves 6% above the closing price of the distribution day. So you can see here, if we take a look at this closing price to Wednesday's high, we had a 6.5% gain. Now, if we move to this next stalling bar and then we go to Thursday's high, we hit 6.82% above that. So both of those distribution days came off of the distribution day count. And now, while on Friday, we ended up avoiding a technical distribution day since price only closed down 0.18%, which is less than the 0.2% required for a distribution day, we did see some stalling action. Now, this isn't totally surprising. I'm going to take off the market navigator. I'm going to put on my pullback warning indicator, which is based on research that John Pocoroba shared. And what this does is it says when the distance between the closing price and the 9 exponential moving average is greater than the distance between the 9 exponential moving average and the 20 exponential moving average, while price is more than 5% above the 50-day simple moving average, a pullback is likely to occur. So that signal started flashing here on Wednesday, and it doesn't mean a pullback is guaranteed to happen or it's going to happen immediately. It's just a warning that things are starting to get a bit stretched and some cooling off could happen, whether that be through price or through time. Now, another thing that happened on Friday was an oops reversal to the downside. What that is when price opens above the previous day's high and then it reverses back into the previous candle. So we had that happen today, and we also saw that happen back here on June 16th. Typically, when you see these, you tend to get some follow through to the downside. However, it's not always guaranteed. So at this point, I'm going to be watching for a normal, healthy correction somewhere between that 3 and 5% range. Again, it doesn't mean it's going to happen. It doesn't have to happen right away, but if it does happen, that's going to put us somewhere between this gap fill here and this 3,500 psychological level. Now, we could also see the 21 exponential moving average continue to rise and also get to this gap fill level, which is another area that would interest me. Next week, we start seeing earning reports from big companies like Tesla. We also have the Fed on Wednesday with Powell's press conference and more inflation data on Friday with PCE. So we could be in for a wild week. Thank you for watching. If you enjoyed this video or found any of the information useful, please go ahead and hit that like and subscribe button so you don't miss any future updates.